We are live. Mr. Putin is winning. The financial markets are tanking. China and Russia's goal, I believe, is to crash global bond markets. And mission accomplished. But that move may be over now. In fact, this bond crash I was expecting to take 2 years has now unraveled in 4 months. But what comes next, and how should we be investing our money? How to get rich in 2022. Buy these 4 stocks now before it's too late. We've really only made one major adjustment to our outlook this year. And so we'll cover what that is in a moment. Pick one is a play that energy prices will go higher and higher and higher as long as there's a conflict in Europe. Pick two is a play that interest rates are about to collapse due to a monumental fall in GDP growth from China's lockdown and from too high of interest rates. Interest rates have gone so fast to the upside that it's going to kill demand. Pick three made 20,000% return in the first 5 years. It's like the new Microsoft. And it will easily go up another 400% in the next 3 years. In fact, it's remarkable how well this asset is holding up in the face of a crashing stock market, a crashing bond market, and for that matter, crashing commodities. Everything's crashing. This asset is flat. It should be getting whipsawed more than anything else in our portfolio, but it's holding strong. Pick four protects your account against a stock market crash and made 1,000% gain in 2020. It's the only asset in our portfolio that's really up today. We've got one flat and one up, two down. So do yourself a favor and put as much money as possible into these 4 stocks before you miss out on massive profits ahead. Now, recent trade alert, we did sell half of our Boyle position April 6th for 139% profit. And boy, oh boy, I wish we'd just taken it all off the table Monday when it was sitting on a 270% profit. But the reason we didn't was because something big is about to happen next week. We need to prepare for Boyle. That's the pick that we took profits on, betting natural gas would be going straight up this year. Now, there's something that's about to happen that could make it go to new record highs. And that's because Europe is saying they will ban all Russian energy exports after the French election. Okay, we've already got Janet Yellen warning not to do this. We've got JP Morgan predicting $185 oil. But the problem is you won't stop Putin until you cut off his money. And so do you want to stop Putin, or do you want to have essentially extreme inflation in Europe? That's the risk reward to stop the war without Ukraine surrendering. Now, our top selling advisory is up 33% year to date for 2020. We've been up as much as 40%. So we're looking at a little 7% pullback this year for our total return. But we're not worried, and we've really made very few changes. Now, this is our high risk portfolio. You should expect volatility. And that's because we're playing very volatile assets that we're expecting huge returns on. Now, last year, this very similar strategy returned 233%. It was the same strategy. The only main difference from 2021 to 2022 is that we've had a bond market collapse, and now we're bullish on bonds because of that. So that's the major change to the portfolio year over year. Now, again, the European conflict's likely to become far worse, and I'm talking very soon. Okay, so I think we're going to see an escalation and then perhaps diplomacy in May. And that seems to be the timeline. Now, remember when this war started, CIA, Pentagon was saying Russia was going to walk in and take over Ukraine in 48 hours. And boy, oh boy, did that not happen. So let's take a look at our current trade alert recommendation for $10,000. Step one, buy 68 shares of UVXY. That's our crash insurance play. It can go up very quickly if you get an acceleration to the downside on the S&P 500. So it's like out of the money put options that are automatically rebalanced for you. It's a beautiful product. And again, last time it went up significantly was March of 2020. We've seen it double this year, and protect the portfolio at the start of the year. But to really get a big gain, you need an absolute limit down market crash black swan event. And right now, I'm not predicting that. Otherwise, I'd be loading you up with this product and getting out of our stocks. But again, that's not what we're predicting in the short term here. Here's a look at the chart. Currently, you can see UVXY has had a pretty big range going from 12 to 22, back down to 12, and then sitting at 14 this morning. Step 2, buy 146 shares of TMF. We are long bonds. I was in the belief that the bond market would crash to about this level, but that it would take 2 years to play out. And my, oh my, there's a lot of factors that have led to this. But primarily what we have currently hurting the bond market is inflation and energy due to the Russia-Ukraine conflict. And now we have China. This is kind of a double-sided sword. So we've got China in an extreme lockdown. So that's going to help cool off energy and food costs. But on the other hand, so it might help China in terms of its inflationary import costs. But as far as the US, this is going to cause more supply chain nightmares and drive up inflation on the consumer side for the US. So again, it does appear this is a coordinated attack against Western financial systems. And so why are we buying bonds? Essentially, the outlook is really good for bonds from here. If interest rates go up any higher, US is insolvent, everything crashes. Yields go back down. If good things happen, if supply chains ease and get fixed, if energy costs fall and there's diplomacy, well, guess what? Inflation comes down, bonds do really well. So extremely bullish on TMF at these levels. It's a 3 times leverage play on the 20-year. And the 20-year actually has a higher interest rate than the 30-year. So you got to love that product. And bonds are very statistically a high probability win rate. And you can see since 1977, bonds just about never lose money. And for them to have lost money for 2 years straight is statistically very unlikely. And so this is a little bit old, but not only is this the longest duration of a bond market crash, it's also the sharpest. So we're very bullish on bonds. And I believe we're nearing the end point of the pain in the bond market. Now, there's some people predicting these rates are going to go even higher, including Jim Bianco and quite a few other people, but we'll take a look at that in a moment. Step 3, buy 171 shares of ETHE. That is Ethereum. This is a lot like Microsoft. It's an operating system for decentralized technologies. It's a beautiful product. It has faster user growth than the internet. And we see very good things in the near term for Ethereum. With everything crashing today, Ethereum is flat. Okay, this is supposed to be something like, well, Bitcoin is supposed to be a leveraged NASDAQ. And Ethereum would be something like a quadruple leveraged NASDAQ. So to see this asset doing so well today and yesterday in the face of the NASDAQ getting smashed, extremely impressive. So just wait for that bond market to cool off. As interest rates fall, we know tech goes up, and that's our favorite play for a cooling off of the bond market. Now, the way to play it safely is in your stock brokerage account. You don't need to mess with Coinbase and worry about getting hacked. Just go with the Grayscale Trust, ticker ETHE. Okay, so you're insured, you're safe, you're not going to get hacked, and you get that exposure to our favorite growth asset. And the easiest way to think about it is you're buying Microsoft when it's 5 years old, and this is the competition. So Microsoft powers centralized operating systems, and now this one is the leader for decentralized tech. Now, let's look at some bullish things that are developing right now for cryptocurrencies that perhaps makes us understand why they're holding up so well. So Japan is already printing like crazy to protect their bond market. In fact, they've been selling US bonds to buy their own bonds. And they're in now what's called yield curve control. They will buy an unlimited amount of their bonds to keep that interest rate at 0.25. And so look what's happening to their currency. It is devaluing. So the purchasing power of the Japanese yen over this chart that you're looking at, and most of the move happened in literally several weeks, is 20%. So that means you have 20% less purchasing power. Just a mind-boggling move here. Now, what's the US going to do if their interest rates keep rising? The exact same thing. Okay, so now China is printing to protect their real estate market. Very bizarre what they're doing with the lockdowns. I believe it's to cool off import inflation and to increase export inflation. So this does seem to be, we're at war, essentially. Now, here's what's happening to the Chinese currency. It's now finally starting to sell off against the dollar. And the only thing that's been stronger than the dollar over the last 2 years has been the Chinese yuan. So they do have some room to print money and protect their economy while they're doing this. So here's what we should expect for the big move up in Ethereum. The second energy prices fall, you're going to expect yields to fall, and so will the dollar. Okay, and typically, it's odd, but when we go into a tightening period in the US, typically the dollar actually falls. So for Ethereum and energy costs to be doing so well in terms of going up in value or maintaining value in the face of a rising dollar is impressive. Just wait for DXY to fall. That's when we're going to make the big money on Ethereum. Step 4, buy BOIL, 38 shares. I may diversify this into NRGU and BOIL as soon as Monday. We've got a little bit of a sell-off in oil. Oil's the big money for Russia. Natural gas is a lot less money, but it would be much more harmful. So if Russia really wants to put pain on Europe, they cut off those natural gas lines, and then it's lights out. That's 25% of Europe's electricity. So I like both. I think BOIL has more upside, but that would probably be more if Putin's trying to harm Europe, that we'd see natural gas go up. If Europe wants to harm Russia, they really need to put pressure on making it very hard for him to sell oil, because that's where he makes all his money. So both make a lot of sense until this conflict has come to an end. So expect to potentially diversify a little more into next week, because I like both, and it's not clear who will make the first move. But after the French election is over, that's what they're talking about, is completely banning exports of energy. Now, will Russia and India fall in step? That does not look like that's the case. Here's a look at BOIL. So we saw it hit 100. It's fallen pretty rapidly this week, but there's no end in sight in this war. So we want to remain long BOIL, and we did take half profits off. Should we have sold some Monday when it was going up 20%? Well, hindsight says yes, but look what's dead ahead. We could be seeing a new move significantly higher very, very soon. I'm talking as soon as next week. Let's look at this strategy on a table format. So if you look at this chart, this is what it looks like in our membership area. If you pay for a subscription, you're going to have access to what you see on the screen, but you can punch in how much money you want to invest and then hit calculate. Now, we're not targeting an asset allocation percentage. We're targeting a ratio of shares. All members have the same ratio of shares, so we make the same return over any given period of time. We split it up into defense for deflationary assets, and then offense for inflationary assets. Makes it very easy to understand. The red is your defense, and the green is your offense. So on the defensive side, we have UVXY. If things break, people lose money, they go bankrupt, they have to start selling everything to try to stay solvent. We call it margin call protection. Well, this tends to happen when the price of different financial assets move in either direction too quickly. And usually it's the people who are doing risky strategies, typically involving selling options or selling futures where they have an unlimited liability. That type of strategy makes a lot of money 99% of the time. But the issue is the 1% of the time when there's extreme moves that are highly unlikely and unpredictable to occur, well, those types of investors, which often are big banks and big hedge funds, can go insolvent and go negative. And they get into a situation where they have to start liquidating everything. This can create a cascading domino effect of selling. And so I believe that is exactly what we're experiencing today, where we see just about everything under the sun crashing. Okay, and it's likely due to the sharp move to the downside in bonds, is the most notable move over the last week. Okay, so right now we have 9.4% of the portfolio in UVXY. It's a decent position size. If we're going to get more bearish, we might push it up to 15. If we're going to get extremely bearish, we could go as high as 20 to 25%. Very rarely have I pushed our portfolio to that level. So we will see. The main thing that would make me want to get more defensive would either be oil skyrocketing up due to these sanctions or the bond market falling below the current levels. So either of those, I do think we're now at a point where it could create extreme volatility. Okay, so that's UVXY, 68 shares per 10,000 bucks. Next play is treasuries. My view on treasuries is essentially that at the end of the day, if we look a year out, treasuries will go up. It's crucial in a number of ways. First of all, if interest rates stay at this level or go higher, the US government goes insolvent and it will crash the housing market. It will crash essentially all markets. Okay, there's extremely low chance that interest rates will remain at this level for very long. So if the energy costs go up due to sanctions, could we get another puke in the bond market? Sure. So there is absolutely more short-term risk in treasuries, but the result would be a financial crisis that drives interest rates back down. So I expect to essentially add to treasuries as time progresses here. And we've been slowly but surely making our way back into treasuries. Now, again, there's two ways they go up. If there's peace, energy costs go down, supply chains get fixed, inflation expectations come down, and interest rates go back down. So that would be the good outlook, and that would also most likely see the NASDAQ go back up. The other outcome would be the bad one. Okay, the bad one would be conflict gets worse, energy costs go up, China keeps everything shut down, destroying supply chains, stock market gets hit very hard, and then you get your treasuries going up. So we're very bullish on TMF. If you can't tell, we'll most likely be adding to that over time. Now, again, if it's good news, I want to get more money into Ethereum or FNGU for high risk. If it's bad news, we'll just load up on treasuries and UVXY. So that's really the fork in the road ahead. Okay, on the offensive side, we like ETHE, that's Ethereum, and we're still in boil. I'll potentially split that in half with NRGU. We did get a little pullback in NRGU. And again, if Putin wants to screw over Europe, he makes boil go up. If Europe wants to try to put pain on Putin and cut off their money supply, then NRGU will likely go up. And now the bond market's on the verge of crashing everything. So every time interest rates go up this high, crises develop. So we're in this channel, and I believe it's either going to be bad news or good news that drives these yields lower from here. And we're going to know very, very soon which is the case. Now, the rumor is Putin wants to declare victory and cool this off in May. So we will watch carefully to see if that occurs. And I think these sanctions they're threatening will potentially make a big difference in that outcome. Okay, TLT, here's a look at that. For debt to grow, interest rates must go lower over time. That's just the way it works. And so now central bankers are trying to design strategies to drive interest rates negative over the next 30 years to keep the party going. And so there's big papers out about it, but essentially they want to create digital money that has essentially a time limit on it. that forces people to go spend the money or you lose it. And so just complete madness, but that's the world we're living in. And another reason why we like both bonds and cryptocurrencies. Here's another look at the bond market. This is the 2-year. This is what's essentially forecasting the federal funds rate into the future. And so it's saying you need to hike rates, fast. And so that's what they're talking about. But so far, all they've done with inflation running extremely hot is jump by 25 basis points. But yeah, once again, yields and energy prices cannot remain at this level. If they do, they will crash the economy. So here's that oil price. You can see it went to extreme highs. It's been trading in a band and cooling off. So my expectation is the second we have a diplomacy, get out of energy, go long growth. So we're only hanging on to oil and NRGU until the conflict is resolved. The second this conflict ends, go long leveraged tech ETF FNGU. I'm glad we waited a little while to do it. I was tempted to pull the trigger on it this week, but boy, it took another big nosedive. So we've already got a huge Ethereum position. I want to go along the 12 great tech giants that are held in ticker FNGU. So it's got your FANG stocks, all beautiful companies that are going to dominate for decades to come. Plus it has Alibaba and Tencent, which are probably the cheapest tech companies in the world right now today. So expect to be selling Boyle and NRGU as soon as the conflict is resolved, and most likely going long FNGU. Okay, so macro, the last time the US went into a tightening cycle while China expanded credit, now we got Japan doing the same, and probably we'll start seeing Europe do it. All these governments are going to have to protect their bond markets. Bitcoin returned 4,400%. So here it was, 2006 to 2018. That's the last time we were hiking interest rates. Now, a little difference. One, there was far less inflation over this period. And then two, they were not selling treasuries. So they were not actually selling off part of the central bank's portfolio of bonds. That is projected to begin simultaneously in May. So it's not exactly the same this time around. So watch every webinar Monday, Friday, and Wednesday to be ready for sell alerts. And if you don't want to miss out and gain access to the membership area, call Dean to upgrade at 505-322-7515. All right, let's take a look at our scorecard. So we have two products. The safe growth strategy is very similar to how Ray Dalio plays the markets. We're going to diversify you into essentially every major corporation globally. So we own just about every company out of Europe, Asia, and North America. We're going to hedge against inflation by being long uranium, rare earth metals, and oil and gas. And we own bonds, plus we have downside protection, plus a big chunk of Bitcoin. So that's really the way this portfolio is set up. It's using leverage. It just took a big whack over the last 48 hours. We were up a few percent to start off April. We've pulled back. In general, I don't think we need to freak out that yields are going to fall and stocks are going to go back up. So at this point, we have not made a change. We're down 10% year to date in the safe growth strategy. And that's using leverage products. So when you consider that, it's not that bad. The high risk strategy, which was up as much as 8% in April, now down 1.4. We lost our big gains in Boyle that we were holding in April. But again, I expect that to potentially break to even higher highs in the next 2 weeks. So we're not freaking out. We're up 30% year to date in the high risk strategy, and we pulled a 233% return in 2021. This portfolio notably has less positions and looks at the assets that can really deliver big gains. All right, now what we're going to do is look at our news feed for topical information, and then we'll go through data and charts, and then we'll wrap this up with looking at exactly what trade alerts we're expecting in the near term. Okay, so Zero Hedge says the market crash will continue until nobody can afford anything and Powell can declare the end of inflation. Luke Grumman says TLT down with stocks down big again. This makes sense if you realize that A, since 1995, US tax receipts have become hypersensitive to drops in asset prices. And B, US tax receipts are barely covering entitlement pay goes and treasury spending today. Liz Ann Saunders says 8 straight weeks of decline in rate to ship 40-foot containers from Shanghai to Los Angeles. This is showing that the inflation is slowing down and the demand is slowing down for the last 8 weeks. And that would indicate that perhaps the Fed does not need to raise rates and sell bonds so aggressively to kill demand. It's already been killed. What we need to do is fix supply chains. Netherlands aims to end the use of Russian gas by the end of the year. Johnson from the UK says Putin's winning in Ukraine is realistic possibility. Live Monitor says it's inevitable, just costly. Who's funding the war? Pretty much only the US. We've got Obama and Hillary saying they're out to stop disinformation. Almost comical. So yeah, they don't want Elon to buy Twitter, and Obama's out there pushing the vaccines. It's popular right now to proclaim the end of the secular bull market for bonds, but I'm not so sure. My long-term view is that a secular trend change is not imminent. The caveat that we don't know what the forward curve will look like tomorrow, let alone in a few years. So his projections are essentially looking at slightly higher rates and then they fall. Now, again, I believe that we're essentially at the top band of what financial markets can withstand. And now we're starting to see that in the assets. "16 food plants catch fire." I haven't dove into that info yet, but yeah, food inflation is going to be very bad this year. Let's look at the demographics of China. Most of the bigger GDP countries are facing bad demographics for the foreseeable future, which is all deflationary. Germany's central bank warns the EU embargo on Russian gas would dent GDP by 5% in 2022, triggering an energy crisis and the deepest recession of recent decades. Jurian Timmer of Fidelity, if the bull market has enough gas to run a little more, it could be fueled by bonds. Bond fund ETFs have taken out $3.5 trillion since the great financial crisis. Even if half of that gets reallocated into equities, that could keep the bull going for a while. The great rotation. Luke Grumman says, how long will China need to watch the CNY fall against the USD, but the ruble rise 5% versus the USD before they use their currency, oil and gold, to defend their currency? First time in at least 30 years that both stocks and bonds are down by this much simultaneously. Where to put your money? So far, we have shipped $13.6 billion to Ukraine. Finland's submitting application for NATO, which Russia, of course, has threatened to not do. We've got something like 300,000 people being caught on the border this month, a new record. Mind-boggling. Texas is talking about declaring the border crisis an invasion. Everybody's joking about David Hunter. This guy's been talking about this melt up about to occur, I think, since November. So I don't particularly know a lot about David Hunter, but just some comedy. And I actually do think rates are going to fall and stocks will go up in the very short term as soon as this conflict settles down. Luke Grumman says, if tasked with collapsing global bond markets and economies as quickly as possible, I do the following. Have the Fed tighten with US debt to GDP over 120%. 2, impede flows of energies and commodities out of Russia. And then 3, impede flows of goods into and out of China. But again, will this go on forever, or will these be short-lived? A lot of pain happening in Europe and Asia due to these decisions. Yellen urges caution on complete European ban of imports of Russian energy, says complete ban would increase oil prices. Is a natural gas crisis coming? Chai Girl says yes. Here's a look at the bond market returns over time. This is the worst in history. We're buying the dip. Okay, very good. I think that really covers the most interesting headlines in the short term. Okay, great. So here's a look at bonds over the last several decades since the 80s. Remember, they got jacked that high through the 70s with Paul Volcker and uncontrollable inflation. But it was a much different world in the 70s. We'll look at the labor force participation rate to see the primary difference. In fact, I'll just jump over to that really quick. So here's your 70s and how you get a decade of inflation. Okay, but what changed? Well, we sent all our manufacturing to Asia, and since then we've had the opposite in the labor force. So that's one reason why I'm highly skeptical that we're going to have a paradigm shift and bonds changing their trend, which is lower and lower. Also, politicians do not want interest rates to go up. So if you believe politicians want to maintain their power and keep spending more money than the government brings in, these rates must stop going up. So I do believe we are essentially very, very close to peak interest rates, and that we should expect the exact opposite from here. Here's another look at interest rates with the TLT. I was telling you guys, if you get 125, I will buy. If we get to 120, I will get very worried and increase buying and get worried about a crash. We're there. So I do believe if TLT goes any lower, we've got big problems and we should sell stocks and buy more TLT and UVXY. So let's see what happens with this conflict. Are we nearing the end, or is it about to escalate? What's happening with energy costs? What's happening with interest rates? This is what we need to focus on. This is the housing market. So housing market's half of global debt. And again, the interest rates have doubled mortgage payments, and this has happened in a very, very, very short amount of time. Much of this has happened only in 4 months. So this is going to immediately put selling pressure on the housing market. Here's the yield curve of the 10 and 2 year. So this is predicted recessions, but about 2 years in advance. So typically you actually have a very bull market after an inverted yield curve. And it's the steepening of the curve that ends up with the recession. So we barely touched the inverted for a split second, and now it's started to steepen. So we'll keep a close eye on it. But again, the short-term reaction is that stocks go up almost always after this has occurred. Here's a look at the yield curve. Ugly, ugly, ugly. We've got the 20-year over the 30-year. We've got the 7-year over the 10, and the 5 and 3-year over the 10. So we've got an inverted yield curve. But notably, the 3-month and 10-year are very wide. And so many people say that's a much more accurate indicator. So we're watching both. 50 basis point rate hike in May is a done deal, according to the futures markets. and we're going to expect $95 billion roll off of the balance sheet. But this being offset by massive money printing out of Japan, China. So that's one reason we're not freaking out about it for stocks and cryptocurrencies. Here's a look at your VIX term structure. That's what we're playing with UVXY. What a wild shape that is. So yeah, we're hedged. And if interest rates if TLT goes below 120, I want to add to the UVXY. And if we get another energy shock, I also want to add to UVXY. Let's hope neither happens for humanity, because it will be a painful period of time for your average Joe if that occurs. Reverse repo hit 1.8 trillion yesterday, down to 1.7. This is a lot of money that is stuck in the special reverse repo operation. When it dumps into the financial system, it could be bullish for assets. This is the Dr. Copper, gold versus copper. They've been trading very similar, very interesting. If we were to see copper going up above gold, that would be predicting higher rates. If it were the opposite, gold going up faster than copper, we would be predicting lower rates. Clearly, this is predicting flat rates, and we haven't had flat rates. So Dr. Copper hasn't been such a good predictor over this stretch of time where we've had rapidly rising interest rates. Okay, in this chart, we're comparing NRGU to BOIL, and dang it, we should have sold our BOIL on Monday and then bought the dip today. But from here to next week, I have a bullish outlook, and that's because Europe's threatening to ban all Russian exports. Now it's going to make BOIL and NRGU go up. So potentially, we will do a trade on Monday and essentially be half BOIL, half NRGU, a good sell-off in both. I like both. And it seems more likely Europe would try to slow down the oil because there's more money in it. And it seems more likely that Putin would use gas as a war tactic. So both make sense. Perhaps NRGU has a higher probability, but BOIL has a greater potential profit. Okay, lumber futures against oil. What we're interested in here is last May, I was very bullish on energy going significantly up, but lumber futures began to fall, and they fell rapidly. And it actually was a leading indicator to predict weaker oil prices. So what do we have today? We have falling lumber prices. So I think the setup for falling energy and falling yields is ready soon as we get China to fix supply chains and end the war. But when will that happen? Here's a look at DXY. So again, we are expecting DXY to go up as long as the war continues. The second energy costs go down, expect DXY to fall. And that's when I expect your cryptocurrencies to go up. Now get this, Bitcoin is up over 1,000,000% from 2008 to current, and the dollar's only gone up. Can you imagine the type of returns you're going to make in a falling dollar scenario? And I do believe the overall outcome of how this government is running the country will result in the long term with a weaker dollar. Okay, so you get something like this period of time, and that's when you're going to see extreme returns in cryptocurrencies. We've been fighting a rising dollar, rising yields. Really, the worst possible setup for crypto has been underway this year aggressively, and it's unlikely to continue for long because it's causing too many problems for too many people. This chart, we're looking at the Japanese and the Chinese currencies against the dollar. Both are starting to devalue against the dollar, and this is due to printing money. China's trying to protect their real estate markets, and Japan's trying to protect their bond market. In this chart, we're looking at Bitcoin down 35%, Ethereum up 22%, and Polygon up 223%. If you are a paid member, you can call Dean and ask him about the private equity offering we have, which is a weekly dividend, and it gives you a super aggressive long position in cryptocurrencies. So for every dollar we have invested in Ethereum, we have about 50 cents invested in Polygon. And guess what? The only darn thing up today is the single riskiest thing in our portfolio, Polygon, which is mind-boggling. But we have Bitcoin down 2.5, Ethereum down 0.7, and Matic Polygon up 2.5. Now, what is Polygon? It's something like the Lightning Network for Bitcoin. So it's my most bullish, high-risk growth asset that I recommend to clients. Now, we don't have it in our portfolio builder advisory because you can't buy it in the stock market. So if you do want exposure to that, call Dean. And again, it's only legally available to people who are a paid member of Portfolio Builder. Now, the catch is we can only have a limited number of unaccredited investors, and we're almost out of those spots. After that, we will only be able to take money from accredited investors. So if you do want exposure and you do want a weekly dividend, call Dean, and he can tell you more about that. In this chart, I'm comparing Ethereum to silver. Is silver the perfect way to reduce volatility with Ethereum? So we've been slowly but surely seeing this trend where gold and Bitcoin have a opposite return over time. So this has been working for about 2 months, but not for much longer. So if I zoom out a bit, silver's had a pretty boring return, down 20%, while Ethereum made it 230%. So watching it, the case for gold and silver is getting better if we're entering a stagflation environment. And we're also messing with countries' reserves. So rather than store dollars for your reserve and treasuries, we may start to see most of the world start to store gold. So that with stagflation is the main case for a play like that. So I haven't pulled the trigger on a silver play. We did make a lot of money being long gold a couple years ago, and then we got out, and we've been on the sideline since. Okay, so this is concerning. We've got interest rates going up in yellow, and then we've got banks and energy companies now falling. Okay, now we don't have the banks on this chart, but that's not what's supposed to happen. Okay, so we'd expect if the yellow line's going up, the NASDAQ, the candlestick below, should fall and the green line should go up. Today, we've got interest rates going up, which means bonds are crashing. Plus, we have pretty much everything falling. So this is not good. And once again, TLT is holding the line at 120. If it goes any lower, watch us get defensive next week. Bottom line is, I think unless Europe really crashes markets by sanctioning oil, that this move is essentially done, and we should start betting on the exact opposite. So John says, why do you like the 20-year instead of the 10-year? More leverage. So every year the bond has, that's more and more leverage. So the 20-year is twice the leverage of the 10-year. And TMF is 20 and 30-year basket, I believe. The dollar will go down over time as people stop using our treasuries and our currency for trade and for, that's the main reason, yeah. So when we go screwing with people's reserves, like Russia's, we scare much of the world out of storing treasuries in dollars, and now they are starting to trade in their own currencies. The other main reason is the US government is running twin deficits. So we're exporting more than we import, or excuse me, we're importing more than we export. So that's the trade balance, and then we're running deficits. So essentially we're exporting dollars to import goods, and then we're printing money at home because we spend more than we make. So we're weakening our currency over time. Now, what stock market do we like if the dollar is going to fall? Emerging markets. So that's where our safe growth strategy has lost money for a year, but remains bullish over the long term. EDC. So here's your return the last time the dollar fell. and that was 2002 to 2008. And you got 7 times so 600% better return out of emerging markets than the US. Here's Alibaba getting smashed down 27% in April. Tencent, Taiwan Semiconductors only down 12. Okay, and lockdown half of China, you're going to crash their e-commerce. So yeah, very, very big crash. Let's zoom out. You just see how crazy this crash in Alibaba is. So with F and GU, we'll have exposure to Alibaba at these lower prices. Here's the peak. So 64% decline in Alibaba, 51% decline in Tencent, compared to a 30% decline in Taiwan Semiconductors. Here's the European index. So, you go screw up supply chains in Europe and get them into military mode. They are now ready to raise more bonds and print more money for longer. So I do think this will end up being a bullish chart here, despite this sell-off due to the invasion of Ukraine. Other plays we have for safe growth are uranium and copper. Rare earth metals. We're not in copper miners. We look at rare earth metals and copper miners as very, very similar. But there's a bigger problem dead ahead for lithium compared to copper. And so lithium and cobalt are the two important ingredients for companies like Tesla and Apple to power their products. And so rare earth metals, REMX, is the input cost for their companies. So those are our two hedges really for alternative energy, REMX, uranium. And over the course of time, these have been very positive returns. They're volatile for sure, but you can see some pretty extreme returns over time. This chart, we're looking at gold to silver. If there's a big discrepancy, I would like to jump into silver. We see the same setup with crypto. So when Bitcoin goes up, you can predict that soon the altcoins will chase it up. So I look at that as a similar setup for silver with gold. And there is an opportunity right now that we can see right here. All right, now we're looking at the core inflation data. We've got 0.1 increase. This is way lower than I expected. This is good news for the bond market. This excludes food and energy. Now, food's probably screwed for a year or two, but energy costs should come down the second this conflict resolves, which I think could be next month. So I think Putin's going to be essentially needing to declare a victory, pull back, and regroup. Maybe his intentions for war and expansion are not over, but I do expect him to take a break here. Meanwhile, we got midterms coming up, so politicians don't want inflation to stay this high leading into midterms. So we will see, but I expect this is the highest core inflation rate and that we're going to see it start to fall from here, and that this will be good for bonds and stocks. Okay, are we seeing a collapse of the US economy? Jobs keep coming online. Labor force participation rate, while still below the lockdown era, continues to rise. Banks are lending money and people are borrowing at these higher and higher rates. No crash in bank credit. Consumers are borrowing massively, $41 billion last month. US retail sales are growing for the last 3 months straight. Consumer spending hits a new record high. The trade balance, we're still importing massive amounts of goods, so the demand side is still hot. Home sales, despite these skyrocketing interest rates, still very, very strong. China's PMI, boy, that did fall fast. Okay, it's causing them to print money. I can see this massive drop on exports right here. So that is concerning. Now, this should lead to lower yields. So with this chart, this would make me want to buy tech companies and bet that energy costs will go down. But what's holding it back? Obviously, the conflict in Europe. So the second that ends, we need to get out of Boyle and NRGU, bet big on bonds and tech. Same thing for Chinese imports. So big slowdown coming from China. But we haven't seen it hit the markets how we would expect just yet because of that conflict. Okay, here's the US balance sheet. This is expected to start rolling off at 95 billion a month. And I believe that's already priced into bonds. Meanwhile, Europe keeps printing money. And they're gonna have to. They've got a lot of problems after all this. Okay, good. So we're about to hop into the membership area and look at some specific trade alerts that we should expect. So this is where your video ends if you're not a paid member. Call Dean to upgrade now at 505-322-7515.